So in this video, what we're going to do is talk about some of the features that appear on an actual candlestick chart, meaning that we're going to look at candles that are strung together and see some of the features that show up. But first, let's quickly review the last video, in which we talked about reading the anatomy on individual candles. So like we said, these green candles mean that the chart, or rather that the stock went up in price during the day, that it opened up down here. This was the low of the day, this was the high of the day, and this is where the stock finally closed, meaning the last trade of the day took place at this price. So just to quickly review, the stock opened up down here, moved around throughout the day, we don't really know where, but we do know that it got down this low, it went up this high, and ultimately closed here. And then conversely, on the red candle, this means that the stock went down throughout the day, meaning that it opened here, which is higher, and then closed down here at the bottom. And likewise, we have the low of the day here and the high of the day here. Alright, and the longer tail means that the stock was more volatile throughout the day, meaning it was moving much more. Alright, and then we have this here, which is the doji, meaning that even though the stock moved throughout the day, it pretty much opened and closed at about the same price. So that's the individual candles that we talked about in the last video. This is what it actually looks like when it's strung together. Alright, so we won't be talking a whole lot about the individual candles, but rather the features that we're seeing when the stock actually gets strung, or when the charts get strung together and we start looking at this longer graph. So what do we pull out of this? What important information do we see? Well, if we're looking here, you would notice, alright, the stock started down here and closed up here, and then the next day it opened at about the same price. Alright, so this is generally what you would see. But oftentimes you'll see that the stock will open at a different price than what it closed at. So we're looking at this red candle. The stock opened here that day and closed down here. But the next day it didn't open at the same price. You can see right here, the next candle, it opened at a higher price than what it closed at. So this right here, what we're looking at, this is called a gap. A gap. And if the stock goes up when it opens the next day, that means that the stock price gapped up. There's a couple of different things that could mean. It might mean that there was some interesting news overnight and that people get excited and they want to buy more. It might mean nothing really. Sometimes that just happens. But one thing that we want to talk about with gaps is that they often get filled. So if you see a gap happen in a stock, alright, this isn't a very good example. Let's actually go further over here where you can see a much larger gap. Alright, so this is a gap as well. The stock gapped up overnight. It closed here and then opened way up here. That's even higher than the previous high of the day. So this might indicate that there was something interesting happening overnight and that the stock decided to gap up. But what I was talking about when I say that gaps get filled, there's a theory out there that if the stock gaps substantially, that means that there's still people that have bought or shorted at this price, and eventually the stock price will come down to meet their demands. And you actually see that happening right here. All right, this is that gap getting filled. That red candle with its long tail at the bottom is the price coming back down to capture these buyers and sellers on this day, and the ones that got skipped over as the price shot up into the next level of trading. It came back down, and this gap got filled, meaning the price went back down to the previous level before going back up. And you can actually see that take place on the next day. Now granted, I just made this graph myself in order to illustrate this type of thing, but it's something that we'll see in actual trading, and then we'll take a look at an actual stock chart in the next part of this class. So keep in mind, when you see a gap that's substantial, the prevailing theory is that the gap will ultimately get filled, and it might not happen quickly. It might be a month down the road, but once that gap is filled, then it's a complete chart and it can continue in the same direction that it was going before. That might seem kind of confusing because it's theoretical, and personally I don't buy into it a whole lot. But it is out there, and you definitely see examples of when it does happen. So let's take a look at some more things that we'll see in these charts. Alright, this one right here, this is called a Gravestone Doji. Gravestone Doji. Recall that a doji is a gravestone or rather just a doji first, is a candlestick where the price moves throughout the day, but it ultimately doesn't really change. It opens and closes at the same prices. A gravestone doji is a particular example that demonstrates when the stock has gone up throughout the day, the market didn't like it, people started selling, and it went back down to close at basically the same place that it opened. And that's typically something that you would see at the top of a chart. You can see here the stock price has been increasing. It continued to go up on this day, but it eventually came back down. All right, this is something that is known as a reversal. All right, and a gravestone doji would be an example of a reversal pattern. When you see something like this is demonstrative of a reversal in price, and you can see that very clearly here. The price has gone up, you see a gravestone, and the price has gone back down. All right, you see something else like that happening right here. This is another indication of a reversal. All right, this one is what you would call an abandoned baby. Some people call it a morning star. We'll talk more about these individual patterns, but know that when you see the stock price moving in one direction, a doji, or sometimes not even a doji, but typically there'll be a doji there, and then a change in the price, a change in the direction, change in trend, you would call this a reversal taking place. And I also just mentioned the word trend. All right, I don't want to get too much into this here, but the trend is simply referring to the general direction that the stock is trading over a period of time. So even though that we see there's some ups and downs going on here, we definitely see that there is a trend. The stock prices are going up. I'll talk more about this in later videos, but you can draw what's called trend lines by drawing a line that matches the low of the day on each day. And I kind of missed it here, but you can see the pattern. The low of the day is going up. And then again, you can capture the highs. All right, they'll never be quite perfect. But you can draw these trend lines. And if you want to be real specific, this is called a channel. So by linking the highs and the lows, you can see, drawing trend lines, what you ultimately wind up with is a general overview of the direction that things are moving. And this can help you trade. What you want to do is try to buy the stock when it's at its lower end of the pattern, or at the lower end of the channel. You want to look for a reversal. Perhaps if we saw this one, it's at the top now. So we might want to sell if we see another gravestone or something like that, indicating that we're about to go and hit the lower end of the channel. And if we draw these out a little bit further, we can start getting an idea of where we want to sell at the top. And then when the stock price comes back down to about here, we might want to buy. All right. So this is called a trend. And this particular trend is called a channel. In shorter term trends, you might see something like this. Oops. Let's try that again. You might see something that looks kind of like this. All right. That would be a downward channel. Very short term. But you have a downward trend, a reversal pattern picking up into an upward trend. So that's what happens when you actually link these candlesticks together, some of the features that you're looking for. So just to review, what we want to notice is any gaps, reversal patterns, and trends. All right. One such trend is a upward channel, and we'll talk more about these in other videos. All right, so these are the things that we want to keep an eye out for. It can help us with our trading by identifying what's about to happen next. And you can't know where you're going next if you don't know where you've been. Or otherwise you're just guessing if you use any other approach. So if this all makes sense, we're good to go. And let's take a quick look at what this actually looks like in real life before this video gets too long. All right, so this is Citigroup as of June 23rd, 2017. All right, what do we see here? All right, take a look here. Actually, let me get a different color. Let's get black. Okay, here we see a gap. All right, where do we see? Let's take a look at what else we've got in here. We see some reversal patterns. You might argue here that these are indicative of a reversal. It's not a very strong reversal sign, but it is one. And if we draw a trend line here, what are we looking at? There's a trend line. So here we have a downward trend. Really, it's a downward channel. And then if you were to link some lows of the day here, You could draw, the lines will never be quite perfect. You can draw some lines in between, but you definitely see an upward channel here. So not too exciting on these charts, but you can see that if you were to identify this downward channel at some point in this trade, then you would be able to pick up some, or sell and pick up some extra money. Take a look at the gap, which can also be indicative of a reversal. And then there's this upward channel going on here. So very simple. We're going to cover some more of this information in the future, where we're going to be looking at some more patterns that show up. In here, actually, this is a great example. Now you can see this downward trend very clearly. So right now the stock is down here. We might be looking at a bounce up to about the $64 mark. Probably a little lower than that, maybe $63.50-ish. A few cents difference from where it is now. And then it'll continue on its downward trend until we see a reversal. We might see the opposite of a gravestone. All right, this is called a hammer. A hammer, which is the opposite of a gravestone, indicating that price is about to go back up. So we might look at a reversal. So before I get too carried away in this, let's quickly review. We're looking at just gaps, reversals, trends, of which channel is one of them, to get an idea of how we should actually execute our trading. And then in real life, it's not quite this clean. Our trend lines have to sometimes go through other candles, and that's okay. We just do the best we can, and it'll give us enough information that we can trade off of it. So I hope this was helpful to you. We're going to be getting into some more interesting features of technical analysis in the next video when we talk about some of the patterns that we're actually looking at and how we can use those to trade. All right, thanks for watching and happy trading.